Are you or someone you know looking to buy or sell a home? When you use a HomeGain Realtor to buy or sell a home, you can get $150. Visit HomeGain.com and click on the Promo 150 banner at the top of the page to get started. Compare HomeGain Realtors and choose your favorite. Complete your home purchase or sale transaction with a HomeGain Realtor, and HomeGain will pay you $150. Get started today by going to HomeGain.com. Welcome back, everyone, to Real Estate 360 Live. I am your host, Ryan Sloper, joined today by my guest, Louis Cammarosano, the general manager of HomeGain. Reminder that Real Estate 360 is designed to build the Washington, D.C. Metro's housing and credit markets one house at a time. If you ever have any questions, concerns, or real estate needs, the best number to reach out to us is 877-245-2030. That's 877-245-2030. Whether you're trying to get your credit fixed to get yourself in a position to buy a home, whether you're considering either short selling your home because you're upside down and you're lost your job or whatever your financial situation was or that's causing you to not be able to make your payments, or you see there's an impending hardship coming and want to find out what your options are, reach out to us. It's 877-245-2030. It's time for this week's Market Movers. We're going to let you know what's going to happen in the markets this week that could sway interest rates one way or the other. This segment was brought to you by HomeGain. HomeGain is the place to get you started buying or selling a home, finding a realtor, and getting real estate questions answered. Go to homegain.com today to see what I'm talking about. All you have to do is type in your home address, and you'll get an instant free estimate of your home's value online. It's a great way to monitor your home's value, and it's totally free. So check that out today at homegain.com. So the first report that we had this week was the new home sales, which actually came out this morning. New home sales actually hit a 2-year high. It looks like they climbed to annual rate of 369,000. This is the most since April 2010 and up 7.6% from the prior month. There was a comment by Brian Jones, the senior U.S. economist for Societe Generale, that it's another sign of life in the housing sector. I don't necessarily know that it's a great sign. I mean, because, we should be building X amount of houses just to keep up with the amount of people that are out there. But it's, I think, a good indication in certain geographical areas like D.C. metro area, Virginia, Maryland, D.C., where things are moving. We have very low supply that, there's a need for new homes at this point, and people are willing, they're getting frustrated and are moving to new builders to look for their home search. Would you agree with that, Louis?
Agree with what?
With the fact that, with the supply being low in these areas, that it's driving...
Oh, in those areas, sure, yes. But in general, there's not a housing shortage. In general, the problem that home builders have is that they're competing with miles of foreclosures. But in the Washington, D.C. metro area, sure, you go to a home builder and try to find, to add to the home supply and the things that you can find that you're looking for when you're buying a house.
Yeah, and I think that's what's kind of skewing these numbers. You know what I mean? I think that there's certain geographical locations within the United States that, properties are moving. You see the depreciation, and it's typically in areas where there's good, healthy job market, which are making these numbers. But I wouldn't read too much into it. I wouldn't necessarily, I think that I'm seeing on a daily basis in the Northern Virginia area that people are vying for contracts. They're missing out 7, 8, 9, 10 different contracts. They're not able to get them to go through. Okay? So I know what the actual sentiment is from people. It's like, well, what are we going to do to get a house? What do we have to do to get a house? Whenever you start seeing that and hearing those things, that's the frustration that's setting in, because these people are just ready to go. They're like, we see interest rates where they're at. We really want to do something. A lot of those clients that were looking for homes, whatever price range it may be, they get to the point where they get super frustrated and they're like, well, let's look at, new builds as well. They're priced a little bit higher, but we can, go ahead and get the house built that we want, and we can move in.
Right. So when inventory is low, then the new homes aren't really having much to compete with.
No.
It becomes an option. But when inventory levels are very high and shadow inventory is even higher, new home builders have to just stop building.
Yep. And I think that's more or less what this, this report is an indicator that, I think that it's just in certain areas. I don't think that this is necessarily the thing that's going on all across the country. Also, Thursday and Friday of this week, there is another EU summit meeting that's scheduled. The question is, well, will there be any significant progress to develop some sort of long-term plan to boost its economies and support the weakening banking sectors? And I think that, I mean, I guess if I were a betting guy, then I would say that probably nothing's going to happen. They haven't come to any sort of thing. I think that Spain has actually asked for some sort of bank aid at this point. So they need money, and I'm sure that some way, somehow, they're going to get it.
And Greece wants to renegotiate their austerity package.
Yep, they want to renegotiate. So it's just more of the same. And this has been going on for months. I don't really think that anything's going to really change other than the fact that at some point I do think that the Fed's going to step in and play a role in bailing them out as well. So we also have, following the Fed statement from last week, an indication that the U.S. economy is slowing. I think we already knew that. The Treasury, like I said, the Fed they're going to continue Operation Twist, which we discussed earlier, which should keep interest rates in the narrow range that they've been trading for the last couple weeks. One of the questions that I get all the time is, well, what do you think I should do? Do you think I should wait to lock in these low rates? Do you think that what is the Fed going to do? And I always tell people, I said, try not to worry about what's going to happen, a couple weeks from now. Take action right now while you know what it is where we're at today. Don't wait 2 or 3 weeks for something crazy to happen in Europe or some sort of stimulus package to give the stock market, legs where all of a sudden then interest rates get worse by a quarter. I mean, it's just not worth playing that game. I really feel like if you're out there and you're just constantly reading the national headlines and the radio, the TV, you'll be super confused. I mean, it takes a real professional to be able to monitor what's going on in the mortgage-backed security market and time the market just perfectly. And even if they are pretty successful at doing that, they can't do it all the time. I mean, I've been wrong when saying that I think that interest rates should go up, but that's in a normal market. This is a market that is artificially manipulated to the max at this point.
I mean, look, you're right, because if all the sovereigns owe tremendous amounts of money, they can't sustain higher interest rates than the debt service of even more crushing than it is. So that's why interest rates are going to stay low.
Yeah, and it's like, everybody's like, well, they're keeping it low because they're trying to help out, the public. They're not. They're not. They're in it for themselves, and it just so happens that, we're getting lower interest rates as far as loans are concerned, but look at the savings rates. They're terrible. You can't save money. You're making practically 0%.
And what do you do with it? Then you borrow money and you buy stuff you don't need, or you speculate in the stock market on it, and that's what's keeping the stock prices higher.
And so you have these huge banks now that are, instead of us loaning money to Joe Schmo for his mortgage, which he might be a high risk at 4%, we're gonna play the market. We're gonna play the market and try to clear 10%. And so it creates all this malinvestment in, like in J.P. Morgan's case, losing billions and billions of dollars.
Well, even there, it's not even malinvestment. They're not investing in anything. They're just trading where they kind of know the parameters, and they generally win. And I think Jamie Dimon made a very smug comment the other day. They said, well, you're gambling with shareholders' money, and he said, it's only gambling when you lose.
Yeah.
It's kind of telling that they generally win most of the time. But basically, that type of trading activity doesn't create any jobs, doesn't create any goods or services. It's just pushing money around in thin air and deriving a profit on the spread from it.
Yeah, instead of investing...
Rather do that, instead of investing in somebody's home or...
a business.
Exactly.
Yeah, I mean, I always thought, if they really wanted to help spur the economy, you go into the small business that you could take him from the level he's at now and really help him triple his business by giving him some capital that he could...
That's too much work, though, Ryan, for very little return, and it's speculative. I take Jamie Dimon's point is if you can trade and in seconds make millions or tens of millions or billions, why not do that?
Oh, agreed. But it's just on a basic level, it's not fair. I mean, the banks that are given the ability to basically, to lend out 10 to 1. They're borrowing the money from the Fed at next to nothing. So
all the rules are in their favor. The regulations keep the smaller people out. The backstop of the federal government, but the implicit or explicit bailout, they definitely win in in this system.
And I think that that's the frustration amongst, many of the listeners that are tuning into the show and many people across the country is that, I think a lot of people are pretty smart when it comes to, just what's going on. I think that they can kind of see, none of this keeping rates low and all the stimulus packages that they have done has actually helped the employment situation.
No, the stimulus ends up going into the hands of the companies that the government favors, like Solyndra.
Yep.
Doesn't really help anybody. And then the keeping interest rates low helps the government and the banks.
Later on, I want to say this week, too, we do have, June Consumer Confidence Index is coming in tomorrow. May durable goods orders Wednesday, weekless jobless claims on Thursday, and May personal income and spending on Friday, along with the Chicago June Purchasing Index and the University of Michigan Consumer Sentiment Index. These are all things while, to you guys out there, you're like, well, was that really going to do anything? They could have small impact here or there. However, like I said, the mortgage interest rates along with that 10-year note has been trading in a very narrow range for the last 3 weeks. I don't think that there's going to be anything really significant that's going to come out of that other than, some sort of drama out of Europe, which could keep rates, at the same levels they're at now, unless the Fed came out and did some sort of stimulus package would help the stock market rally. That would help them, mortgage rates get worse. I don't really see that happening. I think that, once again, if you're sitting on a sideline and you're just waiting for a meltdown so interest rates go, another half lower, I don't think that that's going to happen.
Remember, you can always refinance if it does happen.
Yeah, you can always refinance, and at this point in time, like I said, I feel like it's just that they've set this precedent now that rates are super low. Everybody just thinks that they can continue to go lower and lower and lower. And when is low enough?
But isn't this all, Ryan, like the emperor's new clothes? Because the problems that we've had in Greece and Spain, they've been there for years. It's only in the last, 6 months, a year, anyone's decided to pay attention to it. The United States issue is enormous. It's there. Just no one's paying attention to it. The problem becomes when everyone decides, oh, look, we really shouldn't have these low interest rates because there's too much risk involved in lending the United States money, and I don't want to get paid back 1% of a devalued currency. That's when everything changes quickly.
Yeah, on a dime. You're absolutely correct. We're coming up on a break. When we come back, short sales are actually skyrocketing, and we're going to let you know what that means to the market when we come back.